like 5 billion funds that actually are moving the money, not just announced, but moving the money with good pipeline. That will be a great outcome. So I'm very excited about like this panel. I'm looking forward to actually learn from you, right? And again, I mean, AIB is really keen, right? We are a young institution, we're just 7 years old, but we are really, really keen and actually working together with everyone and bringing those type of capitals together. So thank you very much. I think like now I'm going to invite, Rafaela is the MC, but I will bring also Professor James Key, right, to give the actual opening remarks and knowing what he's talking about. Thank you very much. Thank you very much.
Okay, thank you very much for this invitation to speak on this important subject. And I'm just going to say that this topic actually got quite a lot of prominent attention in the IPCC 6th Assessment Report, especially in Working Group 3 on mitigation. It perhaps received less attention in Working Group 2 on impacts and adaptation, and that is something that I would like to come back to, actually. It's an important point. So in Working Group 3, where I was co-chair in the last cycle, there were two relevant cross-cutting chapters, one on investment and finance and the other on innovation, technology, development and transfer. And investment and finance have been covered in previous IPCC reports, but this was a first time for innovation and technology. So just on what we concluded, on investment and finance, I think there were two sets of messages coming through. And the first set was around the quantification of the gap between current investment flows and the investment needs for pathways compatible with 1.5 or 2 degrees warming. And the second set of messages was around the actions that were needed to stimulate investment flows. So on investment gaps, it was a very clear message. By 2030, investment flows would need to be 3 to 6 times higher than they currently are to put us on a pathway to limiting warming to 1.5 or 2 degrees. There are gaps in all regions and all sectors, but the gaps are biggest in developing countries, bigger than in developed countries. And investment, in fact, would need to rise by a factor of 7 to 14 in the South Asian region, for example. Proportionally, the gaps are lowest in the electricity sector, but they're higher for energy efficiency, transport, and especially for measures related to agriculture, forestry, and land use. Now, scaling up the financial flows is going to require clear signalling from governments and the international community. And the opportunities include stronger alignment of public finance, lowering real and perceived regulatory costs and market barriers, and higher levels of public finance to lower the risks associated with low emission investment. Upfront risks deter economically sound low carbon projects, and developing local capital markets is certainly an option. Investors, financial intermediaries, central banks, and financial regulators can shift the systematic underpricing of climate-related risks. Now, for developing countries, accelerated support from developed countries and multilateral institutions is a critical enabler. So it's scaled up public grants for adaptation and mitigation. Funding for vulnerable regions would be cost-effective and have high social returns. And the options for scaling up adaptation and mitigation finance in developing regions include increased levels of public finance and publicly mobilized private finance flows, especially in the context of the $100 billion a year goal of the Paris Agreement, which, as we know, was not achieved on time. The question of increasing the use of public guarantees to reduce risks and leverage private flows at lower cost, local capital markets, which I've mentioned, and building greater trust in international cooperation processes. Increased flows of funding over this decade can accelerate climate action, including in developing regions facing high debt costs, debt distress, and macroeconomic uncertainty. Now, moving to the technology and technology transfer side, there were also clear messages on international cooperation on innovation systems, technology development and transfer, accompanied by capacity building, knowledge sharing, and technical and financial support, all of which can accelerate the global diffusion of mitigation technologies, practices, and policies. The adoption of low-emission technologies lags in most developing countries, particularly the least developed ones, due in part to weaker enabling conditions, including limited finance, technology development and transfer, and capacity building. Now, I want to talk a bit about IPCC's plans for the 7th cycle, which is just about to start, and it will run between 5 and 7 years, which whisper it we all know means 7 years, so we know what we've signed up for. Now, I can't tell you precisely what will happen because IPCC governments are going to meet in about 6 weeks' time to take decisions on the programme of work for the cycle. But they will do so on the basis of advice and analysis produced by the IPCC Bureau, the scientific leadership. And inputs will include a survey of governments seeking views on topics requiring special attention during the cycle. And of course, any invitations or requests that come at COP28, which we are studying extremely carefully, all the draft texts, to make sure that they are manageable, and a bit of expectations management is running at the moment. We are committed to a special report on climate change in cities, and the nominations for participations we've already had the call, the nominations have closed, and we are now in the process of selecting participants and preparing for the meeting itself. And just to say, we received over 1,000 nominations for 120 places at the scoping meeting. So our colleagues are going to have a hard time making that selection and screening more than 1,000 CVs. Now, in terms of the survey for governments, the biggest cluster of suggestions coming from the governments are around adaptation issues, including the global goal on adaptation, tipping points in systems affected by climate change. And we also have a previous request from COP27 to consider updating guidelines on adaptation, which were actually last produced back in 1994 and are perhaps sorely in need of updating. The report of the technical dialogue of the first global stocktake identified information gaps around exceeding 1.5 degrees and coming back again, which involves carbon dioxide removal from the atmosphere very obviously. So the synthesis of government views on the outputs from the first global stocktake contain multiple various possible invitations for IPCC, which I can say would require the scientific community to clone itself 5 times over if we are going to meet all of these obligations. So expectations management, again, is the rule of the day. Now, governments have already decided to configure the IPCC Bureau during the 7th cycle using the traditional working group structure: physical science, impacts, adaptation and vulnerability, and mitigation. So unless they explicitly decide otherwise, the usual working group reports will be produced. Working Group 3 has already focused on technology and finance, as I've said, but there is a big opportunity to raise the profile of these topics in Working Group 2 on adaptation and vulnerability. And this is going to need to be considered during the scoping process and also through the selection of authors to make sure we have the right kinds of skills. And for me, sensitivity to economics and finance is one of the biggest challenges facing Working Group 2. We also have big issues around engagement with the UNFCCC and other stakeholders. Every 6 months, we have a joint working group meeting with SBSTA, and we have absolutely signalled to SBSTA the willingness to engage more between these formal sessions. For example, with constituted bodies like the Standing Committee on Finance and the Technology Mechanism. So we're sending very clear signals that we want to be policy relevant in this cycle and make contact with a wider range of stakeholders, which, if I can finish here, is why I'm very pleased to come to this particular session and have this engagement with the Asian Infrastructure Investment Bank. So thank you for your attention.
Thank you, Professor Jimski, and welcome to this session, from development to deployment, role of blended finance for climate and nature in developing countries. My name is Raffaele Della Croce. I am part of the Center for Climate Finance and Investment at Imperial College, and I'm also co-director of the Singapore Green Finance Center with a partnership with SMU and the Monetary Authority of Singapore. Many thanks to our host, the Asian Infrastructure Bank, Rodrigo. Thank you for hosting us here today. And please let me thank you again, Professor Jim Skier, for his time, given the busy schedule, of these days. So, before calling my fellow panelists here, I would like to present a few slides just to set up the scene. But before doing that, introducing a bit the... It's okay. Let me just introduce the Climate Finance and Investment Center at Imperial College. We have here the Executive Director, Michael Wilkins, Karen Wang, who has been very much organizing this session. Thank you again. And we have other colleagues, Mili Formikov here. We have a series of events in the next days. This afternoon, Mike will moderate a panel on blended finance, again, if you're not tired of this, at the Singapore Pavilion at 3:30, part of the NGFS work. So the continuation, the dialogue here continue, of course. And the Singapore Green Finance Center, who is focusing on the green agenda. We just had the annual conference last week on nature financing. So from renewable investing, we had a series of reports with the IEA, the center, with the Center for Climate Finance and Investment, and here at COP, we are presenting work on Vietnam and renewables sector, so something very much relevant for the Southeast Asian discussion. We have worked on adaptation finance, and nature investing is definitely an area of work for us. So with this brief introduction to the work we're doing at Imperial, let me just set the scene for this discussion. So Professor Ski just told us about the scale of the investment, the gap that we face, and the big challenges. If you look at the numbers from CPI, we see that 1.3 trillion of climate finance has been measured in 2023, according to the latest report, which goes back to 1 year before. We know about the global stake, which the professor mentioned, the role of finance as an enabler for adaptation in particular. There is the need. And we know in particular the gap for developing countries and emerging markets. A statement to that is challenges in raising the 100 billion that the OECD is measuring, for which we're not there yet. But at the same time, we know that capital is there. 110 trillion of assets under management are in the market. Some good positive side we see from investor side. The latest was the announcement here at the COP of this 30 billion Altera fund to invest in climate infrastructure, something we will come back to because some of our investors here in the panel are participating to this fund as well. What is behind these numbers? What is behind this 1.3 trillion of climate finance? Well, 90% is going to mitigation energy. So only 50 billion or so into adaptation. The sectors for mitigation are mainly energy, transport, and the building infrastructure. Adaptation is focusing more on water sector and mainly on public funding versus the energy sector, which is more towards private funding, private source of financing. What we need to do. Here is a summary of things. It's very simplistic, but we need to scale up investment. And this goes through creating the pipeline of projects, the enabling environment, the emerging markets, even more an issue, but not only in emerging markets, of course. the credible transition planning and the signaling to investors which is needed and for which the COP has a key role these days in providing the path to net zero, the transition, and making sure also this transition take into account the adaptation, the resilience of the investment. The second part is about raising capital, and that gets more relevant, even more relevant into emerging markets where access to finance is an issue. And we know the concessional finance and the development of local capital markets has to be part of the solution. What we're focusing today on is the blended finance, the intermediation of the financial markets. But of course, we cannot talk about blended finance without having the context in mind of what we are facing in the different emerging markets, which means the scale of the investment in clean energy. It means the context, the starting point of different countries to this discussion, state of development of financial markets, the energy intensity of the economy, and so forth. And the macroeconomic conditions, the inflation, the cost risings, which are making the cost of capital for many of these investments very challenging. So what is blended finance? On the last slide, just before opening the discussion, if you focus on the table in the middle, there are different forms of blended finance. We're talking about guarantees, risk instruments, credit enhancements. We're talking about design stage grants, depending on the development stage of the project. We're talking about technical assistance. In fact, there are two elements. The key element here is the concessionality of the blended finance. On the left side of your slide, you have the concessional capital that needs to be involved, which could be multilaterals, philanthropic funds, sovereigns, development financial institutions, coming in at a concessional rate into a blended finance structure, linking up to the right end of your slide with the commercial capital, which could, as a different type of set of investors and stakeholders, from asset managers to pension funds, to insurance funds, to banks. So, with this, just to introduce the discussion today, let me call to the stage my fellow panelists, please. Here. I think I got it. Good? Does it work? Can you hear me? Oh, yeah. Okay, can you hear me all right? Okay, so we start the discussion. Let me first introduce my panelists here. From my left to right, David Giordano, welcome. Managing Director and Global Head of Climate Infrastructure at BlackRock. He's led investment strategies across the Americas and APAC, so covering 2 different regions. Has more than 20 years experience, very much in energy, but then more broadly on climate infrastructure and the different initiative of BlackRock, which has been is part of this Altera fund just launched a few days ago, on top of many other different activities. Savina Carluccio, she's an infrastructure practitioner, a civil engineer, and a resilience expert. She's been for a long time associate director for ARUP, working at the intersection between infrastructure resilience, asset management, and technology. And now she's the chair, executive director of the International Coalition for Sustainable Infrastructure, which is a multidisciplinary, multi-sector global coalition bringing together the engineering community and the stakeholders in the sustainable infrastructure space. And last but not least, Hamid Assefar, welcome, head of EMEA and Sustainable and Impact Investing at Invesco, not Bradesco, Invesco. Invesco is an asset manager managing 1.5 trillion of assets in different regions, also present in Asia beyond EMEA. So, to kick off the discussion, I would ask to each panelist to tell us where do they come to the climate mitigation and adaptation space from their point of view, noting what the professors here told us about the scale of the investment, about the need, the urgent need to act. We're going to get there in the discussion about the blended finance role and the solutions. But first, it's important to clarify where we're coming to this discussion, which is the different point of view. So, David, I will start with you, if you're...
Yes. So you know, maybe just to give you a little bit of context for BlackRock, I head up our climate infrastructure team, which is focused on both the developed world. You left Europe out of there. We're in Europe, the Americas, and APAC in the OECD world. We also have a specific emerging market strategy that mirrors our strategy in the developed world, investing again into what we define as climate infrastructure. That's everything from wind and solar projects, offshore wind as well as onshore wind, and solar at the utility scale, but also at the distribution and behind the meter, which is the fastest growing segment of renewable power installation globally, and that's also in the developed and developing world. We also think about the supporting infrastructure required to facilitate this transition. So things like grid stabilization technologies, as well as just transmission lines in and of themselves to take high resource areas into high demand centers. The electrification of transport is also a very big theme for us, and we see opportunities globally in this area. We're also organized around the transition as an investment theme. And so earlier this year, we basically took all of our private market investment strategies, as well as some of our public markets, and identified products or just products that are either solely focused on or partially focused on the theme of the transition, because this is a massive, and as we saw from the professor's remarks earlier, a massive movement of capital. And it requires both, matching the sources and uses of capital, if you will, in this transformation. And so as we think about this, this is not just, an equity play, it's also a debt play, it's a credit play. It's not just a private markets, there is a role in the public markets as well. And so really thinking about this holistically, thinking about what technologies are emerging and will require capital to scale, and also what industries have the highest potential impact through decarbonization. So, really looking at that whole ecosystem and thinking about it in terms of both risk management from a capital allocation perspective, but also obviously the opportunity to see real economic profit.
Can I have a follow-up question for you? So BlackRock is managing over 9 trillion of 9.4 trillion of asset under management, right?
Correct.
For your clients. But here we're talking about the alternative part of the investment,
right,
and the real assets part of the portfolio. In the real assets, it's climate infrastructure, right? And your reference about having a diverse set of solutions applies to different sort of type of projects as well.
Right. Different risk and therefore different return expectations. Yes.
Okay. In the spectrum of the risk returns that you see in infrastructure, from listed equity to debt, infrastructure debt, where do you position climate infrastructure?
Yeah, I would sort of put it in a classic kind of core plus to value add segment of the risk spectrum. As we think about climate infrastructure, again, we have decarbonization partners, which is a late stage venture, which is sort of the infrastructure of the future, if you will. So digital 10 years ago, if you think about those kind of technologies. But for climate infrastructure, as you sort of think about that bucket of value add to core plus, that's going to put you in kind of a mid-teens, to maybe down as low as 10% type return expectations for that kind of risk.
Okay, great. Savina. Savina, you are the engineer here in the panel,
odd one
so
out,
you're
yeah.
not necessarily the investor one.
Right.
So
Yeah.
where do you come from on this climate discussion? What is your definition also of climate infrastructure?
So yeah, thank you for inviting me. I mean, I was really looking for an opportunity to be in a panel where with people I don't really talk to on a regular basis. And I wish I had more opportunity to. Some of the things you said went over my head completely, but that's okay because I could talk about.
Everything you say will go over my
Okay,
head.
so but that's okay because I come from I'm an infrastructure practitioner, so I designed infrastructure. I was on site. I was supervising construction. I managed multi-billion transport projects. And then in the last part of my private sector consultancy career, I was an infrastructure advisor. I was advising governments, MDBs, infrastructure owner-operators. So I'm a very pragmatic, very practical sort of perspective. At the start of my career, actually, at that time, climate resilience and adaptation were not that in fashion. So I'm not going to give away my age. But anyway, so that's not like what we were thinking about at that time that much. But obviously, increasingly so in the last few years. And so for me, my expertise, I'm a resilience expert, so and not just climate resilience and adaptation, just resilience to all hazards, because obviously infrastructure needs to be resilient to everything that kind of comes our way, right? And part of the resilience is the ability to deal with what we don't already know, like just something, whatever comes our way. So focusing on infrastructure resilience and adaptation to climate change, we're talking about adaptation finance, but it's also adaptation is part of resilience. So when we're thinking about climate resilient infrastructure, there's two. I think a useful framing is climate resilience of infrastructure and climate resilience through infrastructure. So climate resilience of infrastructure is the resilience of the physical infrastructure to climate shocks and stresses. So the ability to withstand, recover from rapidly and adapt to, adaptation is part of it, to climate shocks and stresses. And that delivers as an outcome the continuity of service and reliability. So essential services to our communities and users. And then there is the climate resilience through infrastructure, where we're thinking about wider outcomes. So the co-benefits delivered by climate resilient infrastructure, because we can continue to provide services in extraordinary circumstances, then we need to think about what can that infrastructure deliver in terms of mitigation benefits, equity benefits, environmental benefits. And we're not thinking widely about climate resilient infrastructure in the way I describe. We're missing the trick. We're just thinking about climate resilience and adaptation, but we don't really develop solutions that are also low carbon, are also working in harmony with natural ecosystems. So when I talk to my engineering constituency, that's the type of infrastructure that we really, really need to focus on. So that's kind of, I'll stop here.
Great. Amit.
Thanks for the Asia Infrastructure Investment Bank for the invite. As you said, Invesco is a large global asset manager. We do invest across all asset classes, spanning from equity, listed equities, to fixed income, to private assets, bank loans. And when it comes to climate investing, we did divide climate investing in three pillars. Climate mitigation, which has to do with mitigating carbon emissions mainly. And then you have climate adaptation, which is the ability to modify and change structures and processes, right, for expected effects of climate change. And how do you also make sure that you retrofit or adapt infrastructure to be more climate resilient? And then you have climate transition. And climate transition is how do we make sure we are aligned with the Paris Agreement, and both climate adaptation and mitigation strategies could fit into the transition journey. What I'm more excited about and what we've started to work on at Invesco is how do we make sure we work with our institutional clients and bring solutions that could help emerging markets and developing economies, not only in the mitigation journey, which is quite, I would say, covered by a lot of asset managers, a lot of like corporations, banks, but on the adaptation and resilience, right? Because if you go to Africa, if you go to least developed countries, they have significant adaptation needs. I think emerging markets and developing economies, according to the latest figure, require up to 366 billion a year by 2030 to adapt their agriculture, infrastructure, water supply, and other important parts of their economies, right? And to do that, we need to, in the investment industry, bring solutions that could help institutional investors be comfortable with the required risks and the returns, understand what it takes to invest in those countries, right? And also change the way institutional investors deploy capital towards emerging market, which is macro-driven, right? And you talked about the macro factors at the start. Whenever the dollar is strong, whenever interest rates are high, institutional investors tend to redeem their assets from emerging markets, right? But when it comes to impact investing, we need to recognize that we need stable and long-term funding to deploy capital and support corporations, including SMEs, in those countries. And that's what I'm excited about, and then we can talk about blended finance and the role of blended finance about that, yeah.
That's great. I think a diverse set of also objectives in the investment. We talk about the energy sector, renewable sector, how the adaptation sector and how the approach should be integrated also between adaptation and mitigation. The focus now is very much on mitigation, but adaptation has been left behind. And we know if we want to build a resilient economy, then we need to take that into account. What are the main challenges that you see in the area of focus of your investment in emerging markets, the key ones that you see? And can you give us an example through one of your projects of?
Sure, yeah, I'm very happy to. So maybe just to give a little bit of a backdrop to our climate finance partnership, which is our blended finance emerging market strategy. As a partnership with the French, German, and Japanese governments, along with some foundations. And we're basically have a first loss up to a protected return component in the capital structure to protect commercial investors. And I highlight that only to just show that there really is demand from institutional investors to gain access to these markets. It just needs to fit within their kind of classic risk-return spectrum. And so finding a way to de-risk it at the structural level in the fund, it was the fastest fund we've raised during our time at BlackRock. It was about a 9-month fundraise. We were oversubscribed. And I think that I guess is just, I think one of the key components to this is really thinking structurally, how can we utilize public money, foundation money to really facilitate and catalyze capital into the space. There's a huge demand from institutional investors to gain access to infrastructure investments. They like very much the fundamental characteristics of infrastructure. I think the second challenge in emerging markets has been scale, right? So if I come into that market and I sort of figure out all of the plumbing to put capital in and just as importantly, how to get the capital out in a tax efficient manner, am I going to be able to repeat that, or is that a one-off opportunity? And so I think also committing to a long-term structure and really committing a team to that structure, I think that's a big differentiator and really allows and facilitates our ability to be a global investor in climate infrastructure and partner with the strategic players that are focused in these areas. I will get to your question, apologies, but I just think it's a useful backdrop. And so, as part of that strategy, 25% of the capital will be invested in Africa. And Africa is a super interesting market. I think that there are a lot of really exciting things that will be done on the technology front. And so much like we saw the leapfrogging of landline telephone lines, I think that we're going to see some real technology innovations that happen, especially at the distributed energy level, around a decarbonized microgrid and even macro grid. Our first investment was actually an operating wind project that has expansion opportunities in Kenya, the Lake Turkana project, which was great. It's great for us to be involved in that. One of the things that we see, though, is the institutions aren't necessarily in place to create some of that, to de-risk to an institutional level, institutional capital level. So just some of the fundamentals, and the one that I'll point to is just being able to perfect our real estate rights for the asset. There's just not an office to go to get the piece of paper you need that will facilitate that title insurance. And that's just, it's one very small example. It sounds like a small thing, but it ripples its way throughout the entire capital stack, and it changes the entire kind of risk return perception at the investor level. Now, we've been able to work with that and make it work for this investment, but it's just it just highlights something so sort of basic and fundamental. And oh, by the way, we have the same issue in Japan. So this is not necessarily unique to emerging markets. Yeah. But these are the kinds of things that really create challenges to invest into these markets.
Great. Sabina, you want? I will go to Hamid first because I would like to get the adaptation experience from the Invesco side. You also are involved in initiative with the Global Adaptation Commission. What is your experience in that?
So actually, I've met you at FIX, where we signed an MOU with the Global Center on Adaptation. So what we found in the market, right, when it comes to investing in EM and developing economies, tilting towards the most vulnerable regions, LDC, SIDS, and Africa, is that the debt market is probably the most efficient way to allocate capital from institutional clients, right? And in particular, leveraging the growth of the green, social, and sustainable debt market, use of proceed bonds. What we have found in that market in particular is that the majority of projects are mitigation, mainly in the energy and transport sector. So for us, we've undertaken an exercise to see how can we stimulate the bond market to adaptation and resilience, including infrastructure, resilient infrastructure. The key challenges that institutional investors have when they are allocating to EM is the high perceived risk, and then the unattractive risk-return profiles, right? Which I believe, as David has mentioned, blended finance structures through an efficient use of concessional capital from MDBs or DFIs or philanthropies could help de-risk institutional capital to a certain level that will make them comfortable to adventure into these markets where you don't have track records, where there is a lack of projects, bankable projects, right? So we need to get investors comfortable when they allocate towards that. When it comes to adaptation and resilience in particular, I think there is a case for it, an investment case for adaptation. It has a triple dividend. Avoid economic losses over the long run. You can achieve positive impact and gains. You can also deliver on environmental and social benefits. Those benefits, you can unlock them by investing from, I would say, projects spanning from water to infrastructure, resilient infrastructure, etc. And it's important to have an ecosystem when it comes to EM that works around fund structures, like technical assistance, working with the MDBs who have a long history working on the ground is vital, right? You need to have pipeline building exercises, you need to onboard governments and also corporations, financial institutions who can play an intermediary role, which is vital, right, for institutional investors. So technical assistance will be super key when it comes to those countries to channel capital, institutional capital to those regions.
Great, Hamid. Sabina.
So on the technical assistance, this is something that I advocate for quite strongly, is that this technical assistance is not just limited in terms of multidisciplinarity. So this is a very complex and multidisciplinary problem where you need so many disciplines, and sometimes you just go for one consultant or one kind of company that provides not the full spectrum of expertise that is required. And obviously then thinking from my perspective, the engineering community, this is where, we don't really tend to get consulted at that stage, or we're not very much part of the process. If we are, it's only just one sort of actor. So that's on the technical assistance. The other thing is that I want to say, that I, again, advocate for, is that once we've sorted all of this out, the next big bottleneck is engineering capacity and capability.
Engineering?
So, capacity and capability, or construction sector's capacity and capability. Where are, in the different countries where you operate, do you actually have skills professionals who can implement? Are there codes and regulations and standards that they can build to? Are they able to interpret climate data? Do they have the capacity to interpret the climate data and then turn them into design parameters, actually translate the investment to something that works? So that's something that, I'm really kind of passionate, as you can see, passionate about, because it's the next big bottleneck. And so what we need to do, and I'm trying to do, is actually work out what is the baseline in all countries in the world, or where is the availability, and what are the skills available, because the skills that are necessary to implement this type of infrastructure that we're seeking to implement are not available everywhere, and they are not, they need some upskilling themselves.
Great, Savina. If there are questions from the audience, please raise your hand. There is a mic here. But I also have a question to you, because you are the Asian Infrastructure Bank. I want to bring you in. The Asian Infrastructure Bank is very active on climate infrastructure and the resilient aspects as well. How do you see this need, responding to the issues of the investors here, but also from the engineering community? What's the bank is doing on that? Right. What are your...
Right. As I said, right, I do believe we need an ecosystem. I do believe that the money needs to move upstream. And blended finance needs to start considering that also blended finance has to do with technical assistance and capacity building, right? There's a lot of NDBs competing with private sector on the project on the downstream side. And I think that, we cannot hide, it's like an elephant hiding behind a pole, right? You cannot do that anymore. I think, for 10 years we have been doing that. I think we have been doing blended finance stuff, but still there is a lot of crowding out happening. So my sense is our role is more like moving downstream, try to actually make the good project, build a good project, or prepare a good project for the private sector to actually come and do it. And it has been, the technical assistance has been kind of like underestimated, or kind of like, not taking enough attention. For example, to give you an example, I was talking to the head of IDA, the biggest concessional fund that is, right? And they said, we don't have a project preparation facility in IDA. But this shows how, and if you look at the numbers, the leverage, everyone is crazy about creative accounting, about project finance leverage, right? 1 to 15, 1 to 20, everyone is actually then divides have like 1 to 1 or 1 to 0.8, right, on leverage. But when you go to capacity building, for example, the AIB, is 1 to 50 or 1 to 100. So 1 million of technical assistance can give you 100 million on projects. Right? So if you really want leverage, you have to go upstream, right? And then the money will flow. Obviously, there are some markets where, so for example, here in COP, we have this global coalition for capacity building that G funds, right, is pushing, right? But then I was talking to Rockefeller yesterday and said, we want to initiate a capacity building also in Asia. I think that is where we need to aggregate more. So my sense is that, again, right now, like David's saying, well, we are conquering that space where at least finally we are getting all the capitals together. My sense is that the next milestone is how we actually provide that ecosystem and project cycle, right? So also we pump in money at the beginning, right? So that's the thing. The question I have, is is on adaptation in particular. Obviously, we did our first adaptation bond, right? AIB floated the first adaptation bond in 500 million Australian dollars, right? In just early this year. So that's okay, right? Again, it's all for projects. You need a pipeline, right, to do it. Because, but the question is, you know, and maybe for David is, one of the issues with adaptation, how to monetize adaptation, right? And if you really want a fund to invest in adaptation, is that issue of like, well, how you pay for it, because actually you are defining success by the lack of occurrence of something where you are more resilient, right? So, I mean, because we will love as a bank to get more into that space, but we know attracting, you know, capital or institutional private capital to that is still very, very, very hard.
Well, I think the important thing is figuring out how it's commercial, right? Like, so what's the revenue model around adaptation, and then and what is the sort of commercial construct or commercial prospect for an investor to come in and essentially put capital there? It's a huge issue, right? Like we in our transition scenario, we estimate about 5% of GDP could be lost due to climate physical risk issues that are out there. And so if you're not, I think on the one hand, it's a risk mitigation component that has to be part of a plan. Otherwise, it changes, it'll change the risk calculus going into investing into a company or into an opportunity. Then the other side of that is, okay, to get to your point specifically, is how do we bring in more capital into this space? And we're looking at things like coming up with puttable green bonds that would create an opportunity where you've created sort of a floor for investors around green bonds. I think there's also going to be opportunities where there is sort of a sale leaseback type structure, for lack of a better word, especially with governments, to start to inspire that kind of investment. Australia has a very interesting program right now using capital, concessionary capital, to help facilitate the rebuilding and building in the resiliency of the grid. And so I think that again, I think it's going to require a bit of a shift in orientation from the public sector side, and then then crowding in the commercial capital.
Any other? There is another question, please.
May I, please?
Can you please introduce yourself? And
Right, thanks so much. My name is Julia Policar. I'm also working with Rodrigo in AIB, and I'm leading the adaptation work in our climate team. So this is really music to my ears, because everything we are talking about on the need of monetizing adaptation, bringing more adaptation pipeline is indeed what we're struggling to do. But I think we're slowly getting there. And we'll have a few more sessions on adaptation today. If you're interested, do stay in. But my question is really to Savina, because as we are investing adaptation and we're looking for projects, we're talking to the investment teams, and they're themselves talking to the clients. Everyone understands, the need to do resilient infrastructure. So, it's part of our risk considerations. All of our projects need to be addressing the resilience, and so our infrastructure is resilient. But on the aspect of bringing resilience through infrastructure is what is, I think, really lacking amongst those investments in the teams that we're speaking with. So their understanding of, how do you actually invest in projects that make this wider benefit, that are enabling adaptation, is what we're trying to achieve. So maybe a question to you, Savina, is how can we do that? What is missing for those people working in MDBs like ourselves to understand that, there's also an investment case to, build maybe a seawall, not necessarily through gray infrastructure, but maybe green infrastructure, where you really have these significant benefits, but not to only see the resilience as an add-on, but to see a resilience as more kind of enabler. That's my question. Thank you.
Yeah, okay, so a couple of points on this one. One is one of the areas we identified actually in building the value case for resilience and adaptation is exactly what you say. There is still some work to do to really work out, articulate and quantify, although it's not always easy to quantify that sort of more co-benefit side of the value business case. So that's something that, again, as part of my community, I think we can help, and this is not something that we do on our own, but, this is something that is a bit of a gap, a bit on both sides. There is something that exists in pockets. So, for example, cities, there are some, actually, the cities are actually better at doing this. Maybe the mayors need votes, and therefore, they just, the other thing is, I lost the second point now. The other thing was quickly, perhaps the physical climate risk assessments. The risk assessments that we are doing. There are methodologies that are upcoming, such as the physical climate risk assessment methodology that I'm quite sure you know about. It's a CCRI product. So that's something that is upcoming. It's for existing infrastructure, but it's kind of helping make that case for bringing together asset managers, insurers, and engineers finally into the equation to just actually make that better, make a better business case for resilience and adaptation.
So, Ina, can you add a comment, since we do have in the title nature, talking about co-benefits, I think an important element. We won't have the time here to go through it, but please, there is a big nexus between climate and nature, we know. Talking about infrastructure, nature-based solution is also part of one of the options we have, right?
Yes, so this is very much something that everyone talks about. And again, from my end, that I am, on the advocacy kind of capacity building space, I'm really pushing engineers to rethink the hierarchy of solutions they're considering when they're thinking about climate resilience in infrastructure. So it's not just a seawall, hard concrete, but it's a combination of a perhaps, slightly smaller wall and some mangroves and something that kind of breaks the wave, strength. And therefore, then you reassess a few years down the line and maybe make the wall taller, but you don't really need a big wall to start with. So that's a kind of hybrid solution that we really push for. And one last comment on the natural elements is just everyone talks about nature-based solution. I think we need to be shifting toward nature-positive infrastructure, because when nature-positive, it means that it doesn't just use natural elements, but also works with the natural elements, delivering a net gain for natural ecosystems in terms of diversity. And that's where it works best, because it's that reciprocity of relationship between the infrastructure, and protecting the communities, and then the nature, getting something in return.
Thank you, Savina. There is one question in the back, and then we need to wrap it up. So a synthetic...
Hello, hi.
Hello.
My name is Hannah. I'm a tech entrepreneur. We have built a layer 1 blockchain protocol called IXO, and we do digital MRV of real-time measurement of the impact outcomes. So that requires investment into not just hard infrastructure, but also digital infrastructure to really derive a quantifiable benefits and verified claims and credentials. And that in itself will also allow for innovative financing mechanism like bond mechanism that actually has ability to really adjust your risk level because you have that real-time measurement. So maybe a question for maybe anybody here is, are you looking into these kind of also digital infrastructure, which is more of a means to kind of bridge that whole gap around auditability and unlocking some of the financials? And what's your approach to also being open to using tokenization to really enable all that?
Anyone? Short answer?
I think one of the key barriers as well that we didn't touch on is data.
Yeah.
And collection of impact data in particular when it comes to investing in emerging markets and developing economies. And I do believe that blockchain, tokenization could provide some add value there, right? To collect the data, to fund providers, but also institutional capital who have similar requirements as development finance institution or MDBs when it comes to impact measurement. And yeah, I do believe that like investing in technologies or infrastructure, digital infrastructures that could help us improve how do we report back on those KPIs, how do we monitor projects will be key moving forward to make sure that we have a standardization as well in terms of data across the globe, because that's gonna break the barriers to investment in EM in general.
Thank you. We need to wrap it up. I would ask to my panelists a 1 minute answer on what do you expect from the COP? What would be the major expectation from COP which would help your work on this discussion?
You know, I really feel like we're at a time of implementation right now, and so I think I think the focus should be figuring out, and what I'd like to see us continue to do is focus on the solutions within the constructs that we already have, rather than that sort of magical thinking about some other change in policy or otherwise, but really work with what we have.
Great.
I couldn't agree more. For me, it's forming that ecosystem that you're talking about. I think that's a golden opportunity to do this at COP, and that's the best outcome you can get. We all know what we need to do.
What I would like to see is more standardization of information disclosures coming from development finance institutions and MDBs. I think that will help scale up private capital, and it will encourage and create an enabling environment for us to play a key role and complement public sector in funding those climate investments.
Great. So plenty there. We could go on and on. And there's this is just at the beginning of the discussion. There are plenty of other panels on the same topics. Key points for me, just going through quickly the resilience of infrastructure, but the resilience through infrastructure, which was mentioned. The need for quantifying the co-benefits, that's where the nature discussion comes in, where the data management, the standardization that was just mentioned is a key, as a key role. The role of debt for adaptation, the Asian Infrastructure Bank bond issuance, which is a first, the technical assistance importance of multilaterals and institutions, the revenue model for adaptation beyond access to finance is also about where the money is coming from, who is ultimately paying for it, and that's not necessarily included in the discussion talking about financing of infrastructure. So great, we leave it here. Thank you very much. Thank you, my panelists. Thank you for being here. Thank you, Rodrigo. Yeah.